Recently, a lot of Australian property investors have begun dumping their investment properties, doubling the number for sale. As a result, there's now noticeable resistance to price increases, which may slow down the pace of growth. The situation raises a critical question. Will the current market boom fade away in the coming months, or could we even see a period of stagnation? At the same time, Victoria, the state where Melbourne is the capital, is considering implementing a 2-year rent cap, which is another blow to the property investors after introducing higher land taxes just a little over 2 months ago. The money collected from these measures is going to repay the massive debt incurred by the Victoria government in COVID, a repayment progress that could span a decade. This could trigger an exodus of investors from Melbourne, leading to a sharp rent surge. So given the current situation, how should we, the real estate investors, respond and more importantly, keep your money safe? Hey there, my name is Alex. Welcome to my channel, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. With more than 10 interest rate hikes in Australia, efforts to combat inflation have begun to show results. The latest data shows that Australian inflation has dropped from 7% in the first quarter of 2023 to 6%. Although this is not as rapid a decrease as the US experienced, it is a sign of relief for many. People often think that Australia follows the fiscal policies of the US, and as the US is nearing the end of its interest rate hikes, Australia isn't far behind. That's indeed the case. However, the impact of interest rates on the property market isn't immediately noticeable. Firstly, inflation is a lagging indicator, only reflecting events that have already occurred. The effects of interest rate adjustments impacting decisions on buying and selling properties take at least 3 months to manifest. Even if cash isn't an issue, the buying decisions can be made instantly. Selling is not as quick. Hence, since March, we've observed a market where housing supply falls short of demand and housing prices have surged. In the second quarter of this year, the average price in Australia's capital cities increased by 2.7%, with Sydney leading the way at a cumulative 5.3% over 3 months. Everything seems to be moving in a positive direction, especially if you've bought a property and enjoyed the price increase. But for those who haven't bought a property, they watch as prices rise relentlessly, and their house hunting ambitions are gradually shifted from their favorite areas to less desirable nearby suburbs. However, in June and July, we noticed an increase in the property listings on the market. A large number of investors began selling off their properties, and there were signs that housing prices were starting to ease. By mid-July, the number of investors selling properties through auctions skyrocketed by 100%. In the Sydney market, the number of investment properties auctioned accounted for 40% of the total sales. And the trend in Melbourne was similar, with the proportion of investment properties auctioned reaching 36%. With investors rushing to sell, the supply in the entire auction market increased by 17% in the past month. And the auction clearance rate also slightly decreased compared to the previous weeks. This could suggest that the market heat might be gradually dissipating. Of course, whether this is forming a trend is yet to be seen. So why are so many investors beginning to sell their properties? What impact does this have on the market? And for buyers who want to enter the market immediately, is this good or bad news? The primary reason investors buy properties is to make a profit. From this perspective, when investors sell properties, it is either because property investment isn't profitable and they are choosing to withdraw, or they are forced to sell due to financial difficulties. Regular viewers of our channel would have gathered one of the key patterns of Australian property investment. Australian property trends follow a short-term fluctuation plus a long-term bullish pattern. Given the long-term bullish outlook, holding properties is the best strategy in the long run. Therefore, the only reason for investors to sell properties now is short-term fluctuations, and they're forced to sell. That's exactly what's happening right now. People who bought properties during the pandemic 2 years ago were locked in extremely low mortgage interest rates. At the end of 2020 and the beginning of 2021, one of the big four banks, the Commonwealth Bank, officially announced a 2-year fixed rate of 2.14%. Even before any discount. These loans began to mature between March and June 2023, suddenly converting to an interest rate of 6.3%. Although rents in Australia have skyrocketed since 2022, especially in 2023, the combination of high levies imposed by the state governments, higher leverage ratios for investors, and the heavy burden of interest payments creates tremendous pressure. Many people who overstretched themselves to buy houses during the pandemic already experiencing tight cash flows, now have no choice but to sell their properties to relieve the stress. But don't take it wrong, not all these investors are making a loss. People who bought houses during the pandemic and held onto them till now, provided they bought the right properties, used 20% cash and 4 times leverage with extremely low interest to achieve a 15% to 40% increase in house prices. Of course, if they'd controlled the leverage ratio and maintained good cash flow when buying the properties, they could hold on for a longer period, wait for the house price to stabilize and rise, and gain long-term appreciation without having to sell. But even if these investors sell, they've still made a significant profit. The chart shows the proportion of investors selling houses in certain suburbs is relatively high. The highest is Melbourne's inner city area, reaching 55%, followed by Sydney city centre and inner south suburbs. Overall, it's primarily investors in city centres and nearby areas who are selling. This further reinforces a very important principle. Suburbs with a high proportion of investors have larger fluctuations in house prices. Investors entering the market to sell properties have increased the supply, easing some of the pressure on house price growth. We have already seen this in the auction clearance rates, but auction clearance rates only account for second-hand properties participating in the auctions. Well, it can represent the overall market trend, but does not reflect other privately sold properties and new house sales. Especially, it doesn't represent the Perth property market because people in Perth don't like property auctions. Although the population of Perth is comparable to Brisbane, the number of properties participating in auctions is less than 1/10 of Brisbane's. Outsiders usually find it difficult to understand Perth property price trends from the publicly available information. For those currently buying houses in the market, a slowdown in price growth is definitely a good thing. As the slower the market, the higher the chance of catching up with it. The mentality of house buyers is quite interesting. Those who haven't bought houses hope for price drop, while those who have bought hope for price rise. It seems that in terms of property investment, people's views on the market are directly related to their position and interest. During the times of house price fluctuation, the majority of those who are bearish on the market are those who have not bought houses. Those who have not bought houses earn money with their own hands and still want to keep up with the rise in house prices. Those who have bought houses make money just by doing nothing. From a wealth point of view, it's still that old saying, the poor earn money through labor, the rich earn money through leverage. After talking about the big picture, let's take a look at the major event of the Australian property market and see how this state government brutally suppresses property investors. If you've been wondering which state government is suppressing property investment, well, it is Victoria again. 2 months ago, in the Victorian budget, they imposed higher land taxes on investment properties and doubled the absentee owner surcharge. Once the money is collected, where is it going? Of course, it's used to repay the huge debt owed by the Victorian government during the pandemic. In order to repay the debt, the Victorian government has even cancelled the Commonwealth Games. The Victorian government will undoubtedly strive to alleviate the pressure of debt repayment and interest by collecting more taxes over the next 10 years. A significant part of this tax revenue will come from property investors. A new round of taxes and policies is on the way that may force more property investors to leave the market, reducing the momentum for property price increases. In short, the policies proposed by the Victorian government include a rent cap and hotel short-term rental tax. Victoria may enforce rules that only allow for a rental increase once every 2 years for investment properties and set an upper limit for rent increases. According to the Premier, these measures are intended to alleviate the tight rental market, the insufficient supply of rental properties, rapid rental price increases, and the growing difficulty of finding a rental property. They aim to employ all possible policies to increase supply and reduce rents. However, limiting rental increases to once every 2 years and setting an upper limit for rental increases has nothing to do with increasing the supply of rental properties. Due to rising interest rates, the cost of holding investment properties is continuously increasing. If the Victorian government does not allow rent adjustments based on market conditions or interest rate changes and restricts the limit for rent increases, this may cause more investors to exit the Victorian property market. When properties are sold, they can indeed be sold to those who are unwilling to bear high rents and thus choose to buy. But a considerable number of tenants are not voluntarily choosing to rent, but are forced to, because they can't afford to buy. And now, with fewer investors, fewer properties, It's hard to see how this could ease the pressure on Melbourne's rental market. The state government, of course, will try their best to smooth things over. However, they probably also know that forcibly controlling rent increases, besides benefiting their voter base, cannot solve the actual problems. Therefore, they plan to introduce another bill to impose additional taxes on hotels and short-term Airbnb rentals, hoping to convert more short-term rental properties to long-term ones. I'm speechless. How can taxing hotels increase long-term rental supply? Imposing a tax on short-term Airbnb rentals might convert some to long-term rentals, but adding $5 only per booking doesn't seem to affect the landlords much. Short-term rentals don't have a rent increase cap. Doesn't this force long-term rentals to become short-term ones, reducing the supply of long-term rentals? The underlying logic is to collect more taxes to repay government debt and gain votes. This little trick is easily spotted by everyone. As we discussed earlier in this video, many Melbourne investors have already started to sell off their properties in the market. When a property is sold to an owner-occupier, the market loses a rental property. Some investors have openly stated that the rent cap would be the last straw that breaks the camel's back. Once the policy is implemented, not only will more investors exit the market, reducing the supply of rental properties and increasing rents, but also the living costs of Melbourne's renting population will continue to rise. Remember during the pandemic when a large number of Melbourne residents moved to Brisbane? I guess we will soon see a second wave of interstate migration. In a previous episode, I suspected that the Victorian government, to repay debt, might continue to target property investors in the future. I didn't expect this future to arrive so soon. If you made it this far, please give a like, subscribe, and share this video with your friends. Turn on the notification bell to watch new weekly videos, and follow me on social media at RealCoachAlex. Hope to see you soon. Have a good one. Bye-bye.